Friends, if all of you can take your seats, we can get started with the evening's program. We are sure there is plenty of networking time after the speeches and the awards function as well, over cocktails. So, we invite Ashwin Advani, Head of India Office of Investment Cafe, who are one of the sponsors of Apex'13, to provide the welcome remarks for the evening. Before I welcome him to the podium, here's a quick introduction about Ashwin. Ashwin Advani has over a decade of experience in architecting and developing web-based solutions for the alternative investment space, focusing specifically on GP to investor communications, contact management, general ledgers, and IRR calculation. Mr. Advani heads Investment Cafe's India office, as well as system development and support in the region. Welcome, Ashwin, to the podium to make your welcome remarks.
Dear friends, I'm delighted to welcome you all at the Venture Intelligence 2013 Apex Awards function. The day-long event has seen some very interesting discussions that have dwelled into the details and brought up to date with the key issues influencing the world of private equity, venture capital, mergers and acquisition transactions. The Apex Awards function caps off the event with three key areas of focus. First, we will hear from our special guest for the evening on the broader picture, including the latest trends in the economy and the public markets. Although these trends are not very apparent on a day-to-day basis, they obviously have a significant impact on the world of investments and their transactions in the medium to long term. The speeches will then be followed by a short awards function, recognizing the best of private equity and venture capital funds for the year 2012. We will then close the evening with networking over cocktail in a relaxed setting. We at Investment Cafe are very happy to partner with Venture Intelligence to bring you this unique event. Investment Cafe has remained committed to this industry for the past decade. Today we service about 3,500 associated investment vehicles on our platform. We have around 46,000 investors that log in from 120 plus countries. We are now within the eFront umbrella, and we continue to remain committed to this industry by developing the best solutions, the best technology to make your life easy, your communication with your LPs better, and help you benefit with the best industry practices adopted by some of our 400 plus clients worldwide. So I do look forward to interacting with you through the course of the evening. Thank you.
May now request Sesh, MD of Basis Fund Services, also co-host for the evening, to introduce Dr.Subir Gokarn, which will be followed by his speech.
Good evening, ladies and gentlemen, Mr. Gokarn and Mr. Chauhan of this. It's a pleasure for us, on behalf of Venture Intelligence, Basis, and all the sponsors, to invite you here at the function. It's a privilege and honor that you accepted our invitation to be here and share with us your thoughts and ideas in general. Dr. Gokarn needs no introduction. I think everybody in this audience knows him. However, it's my duty to introduce him. Dr. Gokarn, currently in transition, was earlier the Deputy Governor of Reserve Bank of India, and prior to that, in various capacities in and outside India, in various institutions. Prior to joining the Reserve Bank of India in 2009, he was the chief economist of Standard & Poor Asia Pacific, executive director and chief economist of CRISIL, chief economist at the National Council of Applied Economic Research, New Delhi, and associate professor at Indira Gandhi Institute of Development Research, Mumbai. Dr. Gokarn is a PhD in economics from Case Western Reserve University, United States, and also a Fulbright research scholar. As all of us know, we do hear Dr. Gokarn speaking out and also contributing to a lot of articles, and I myself have had the privilege of having read a lot of his articles on the state of economy, monetary policies, etc. Sir, we welcome you to this function. Thank you so much. Have a great evening.
Thank you very much for inviting me to this event. Let me congratulate the winners of the awards that are to be given out a little later, and also to express my sense of appreciation for being asked to provide a macro perspective on the economy to a group of people who I usually associate with, being much more focused on the nitty-gritties, on the ground realities. I have never been an entrepreneur. I've never dealt financially with venture capital. But when I was sitting at the table just before this event began, or the session began, I was asked to, make a prediction about interest rates. And my answer to that was, well, that's now my revenue model. You want forecasts from me, you're going to have to pay for them. So I'm going to, my free offering, if you will, is a historical perspective, and that's what I'm going to do. I want to just provide some perspective on India's experience with high growth, because I think when it comes down to identifying a macroeconomic scenario or conditions in which business thrives, in which business does very well, in which opportunities open up for different kinds of activities, in which risks are kept low and are easily abatable. We have to look at a scenario which actually gives us concrete evidence of all of this happening, a sort of virtuous circle between the macro and the micro. And we have, of course, very recent experience of this. When we look at the period between 2003 and 2008, we did go through a very strong virtuous circle of good macro feeding into good business opportunities, into good business environment, and that circle being reinforced. So it's important for us to understand, if we are to attempt to recreate that kind of record, what these macro factors were. That doesn't necessarily lead to any very firm conclusions about what can be done to restore it, because the environment is complex and it requires a lot of different things to happen for that kind of scenario to be restored. But we have to understand it in order to be able to act to get it back in place. So I'm going to identify, let's say, 6 factors as critical, or having played a critical role in what we achieved in a period when the economy grew at close to 9% a year for 5 years at a stretch, and actually really created, I think, a very optimistic and positive view, not just domestically but globally as well, of the opportunities and the potential for the Indian economy in terms of the size of the market, in terms of the variety of customer segments that existed, and therefore the variety of business opportunities that are not just horizontal across sectors but also vertical across different income segments, and so on. So kind of very full and rich matrix of market opportunities emerged during this period, and I think that's really the template which we need to use as a basis for judging how these opportunities are re-emerging or being reinforced. So let me get to these 6 factors. The first one is global, and I think on that scale, we have to keep in mind that what the global economy was doing in that period, 2003 to 2008, is very, very different from what it's been doing over the last 5 years and what it's likely to do over the next few. Global growth, is the world GDP growth during that period was around 4.3% a year. In the last 5 years, from 2008 to 2007 to 2012, it's been about 2.6 or 2.7. So we've seen a very positive global environment, a kind of rising tide force that helped all emerging markets, some more than others, but all of them were benefited by this rising tide. That tide has now abated. So when we look at before crisis and after crisis, this is a very sharp contrast and a very important difference in the kind of environment that economies face today relative to what the situation was now about 10 years ago. Rapid global growth is an opportunity for economies to plug into. They have to have the domestic capacity, the domestic resources, the willingness, the outlook to plug into that opportunity. But I think when we look back at our own experience, we clearly did in many ways plug into that opportunity, particularly on the services front. We all know the IT story. I'm sure a lot of you are from the IT sector, which is really the sort of where the concentration of new enterprise actually emerged. That is another story in and of itself, but I won't get into that, why there is so much of a concentration of entrepreneurship in this sector. But the global environment is very positive in terms of creating this rising tide of demand and market opportunities. The ability of emerging economies in general, but India in particular, to plug into it as a result of a combination of domestic resources and strategy was very high, and so we all benefited from this. The other aspect of the global environment that was very positive then, and we know and we can see now that there is a very sharp reversal in that, is energy. The fact that the average price of oil over that 5-year period, if you take away the last 1 year, the last year and a half or so when it started to rise very sharply, was somewhere in the range of about between $30 and $50 per barrel. And after 2007, it's been closer to 100. It peaked at 147 in July of 2008, just before the Lehman collapse. It's not gone back to those levels, but even as the global economy has slowed, the average oil price has remained in the sort of 100 to 110 region. I'm talking about Brent. And this is a huge, huge burden on growth and inflation for all economies, particularly economies which are on the sort of rising cycle of energy intensity, which we clearly are. We are in that situation. So high growth, if we place it in the global context, was associated with very strong global growth drivers. We cannot ever argue about decoupling or a lack of integration. It was very strong for us. And benign energy prices. Both of these have reversed post-crisis and provide some explanation for why the macroeconomic environment has deteriorated since then. Let me come to the domestic factors. I'm going to highlight 5. 4 of them are conventional macro factors, and one is, I would say, a one-off kind of a positive shock, which I'm sure, again, many of you benefited from, saw opportunities in, and took advantage of. The 4 macro factors I want to highlight. One is low inflation. We went into that high growth phase with inflation in the sort of 4 to 5% range, and it provided, I think, a very significant backdrop and a support for the ability of monetary policy to accommodate growth, to sort of keep interest rates relatively growth friendly, And this in turn kind of stimulated investment, which is what I'll come to at the end. But of course, inflation started to become a problem during that phase also, which suggested that the economy was growing somewhat faster than its capacity could handle. So demand side pressures, what is called overheating, was visible in the macro numbers from about 2006, 2007 onwards. But the beginning, the initial conditions, if you will, for that growth spurt was low inflation. So now we keep that in mind when we look at the inflationary scenario as we go forward. The second was a very, very dramatic improvement in the fiscal situation. The combined fiscal deficit, that is center and states together, as a percent of GDP, went down from about 9.5%, 10% of GDP in 2002 to about 4% of GDP by 2008. And this actually suggests that what is called the fiscal multiplier, if you've heard this notion being discussed, particularly in the European context, that is when the government starts to spend less, does that help or hurt growth? And I think the answer to that is very straightforward. There are circumstances in which it helps growth, and those are circumstances in which private investment, private spending is willing to step in to fill the breach, and there are circumstances in which it hurts growth. That is when private spending, as perhaps is the European situation now, when private spending is loath, is reluctant to step in when the government exits. So having created a sort of buzz, a kind of a positive sense of where the economy is growing, even as the government was reducing its spending, it was more than offset by productive private expenditure. And I think that was a critical kind of contributory factor. Government spending less, private sector spending more, adding to productive capacity and therefore adding to growth. Even within government spending, the composition changed quite substantially. Just to give you some comparative perspective, the share of capex in total government spending in 2007-8 was about 23%. This was the peak of that cycle. Highways are the most visible sort of manifestation of government commitments to capex. Now, in the last budget presented, 2012, 12-13, capex as a share of government spending was 13%, which means essentially that consumption spending by government has now started to crowd out or push out capital spending, capital expenditure. And that, I think, is very sort of negative from the viewpoint of growth sustainability and growth acceleration. So government spending less overall, but reorienting its spending towards capital, to asset creation, assets like roads and other large sort of very basic infrastructure is something that clearly supports growth. This is a no-brainer. It's obvious that this would happen, but we have evidence, we have the experience of the visible benefits of this kind of reorientation. The third factor is what happened in the balance of payments. We are chronically a current account deficit economy, but for many years there's been a belief that you need to contain the current account deficit. It doesn't matter if you have one, but you've got to be sure that it remains within some limits. And that number was pegged at something like 3% of GDP. You can debate the merits of that, but over this 5-year period, we actually saw the current account deficit shrink to, or in some years, less than 2% or close to 2% of GDP. But in other years, 3 of those 5 years, we actually had a current account surplus, which is absolutely unprecedented for us, and of course remains now a very short episode. Why did that surplus emerge? Because of the kick that ITES provided to exports during that period, but essentially reflected a very dramatic change in the external situation of the economy. During this period, we had massive capital inflows. Obviously, the investment climate was hugely improved, global liquidity, global optimism, whatever, and the benefits that, or the returns that were being generated by Indian business. So we had something like a 1% or more net balance of payments surplus, which of course led to rupee appreciation and so on. That's again a sort of an outcome of the process. That scenario has got completely reversed after the crisis. We're today looking at a current account deficit of over 4%, substantially over 4% of GDP. And in a scenario where, while there is global liquidity in plenty, global appetite for risky assets is clearly less than it was before the crisis. So even though there's money to be invested, investors are a lot more cautious, nervous, wary about investing in what they would consider to be relatively high-risk assets. And so the ability to fund this current account deficit, which is large enough as it is, through sustained capital inflows, particularly long-term capital inflows, is becoming more and more uncertain. So this again reflects in currency dynamics, and so the change in the balance of payments position in terms of the relative magnitudes of current account deficit and capital inflow, capital account surpluses is a key reason why the rupee has behaved in the way that it has. So again, we're seeing a reversal of a very positive, healthy macroeconomic trend as a result, partly global conditions, as partly domestic, becoming sort of somewhat more antagonistic to growth sustainability. And the sort of outcome of all of this, if you will, is what happened to investment. Aggregate investment to GDP was in a sort of narrow range of between about 24 and 26, 27% of GDP for a long time up to 2003. And after that, it went up to very sharply to a peak of about 38% of GDP by 2008. So we saw a 11% increase in investment to GDP over a 5-year period, which has to result in more capacity and therefore more growth. This was a combination of public investment, which I talked about in the fiscal context, and private investment. We've now seen that turn around. The investment cycle, as we all know, is being seen as very negative. It's gone down to about 31, 32%. So it's not back to the old days, but it is a pretty significant reversal. And that is, again, correlated to a large extent with the kind of overall slowdown in growth that we're seeing. So to summarize these macro conditions, after the crisis, we've moved from what I would consider to be a very conducive environment for growth, low inflation, declining fiscal deficit, shift in government spending from revenue or consumption to capital, a very manageable, very benign balance of payments scenario, and all of this translated into rising investment. We're in a situation where inflation is high, the fiscal situation has turned very substantially, the deficit has increased, and the composition has moved back towards consumption spending. The balance payment situation has turned somewhat adverse, and investment has gone down. So I think when we look ahead to the challenges for policymakers, it's essentially finding a way to reverse all of these domestic trends. It's not undoable, it's not something that is outside people's control, but I think decisive actions and some rather aggressive sort of steps need to be taken to start getting this under control. The global situation is what it is. We can't do very much about that, but we can do things, for example, dealing with energy subsidies to try and provide some degree of insulation, some degree of disconnection, decoupling between what's happening globally and its impact on the domestic economy. The sixth factor that I want to highlight is, I would call it as a one-off productivity shock, which is particularly, I think, the contribution of the telecom revolution. We saw post the announcement of the new telecom policy in 1999, a massive, massive increase in connectivity, in not just spread of basic connectivity, but also very rapid increase in the quality and the sophistication of telecom services. And to my mind, this was a huge, huge contributor to productivity. So when we have high growth, we actually have to break it up into what comes from creating new capacity, which happened through the investment bump up, and what comes from improving overall productivity, which I think Of course, many things contributed, but this very discontinuous, non-linear change in telecom was a huge contributor. Now, this dies out. This peters out over time, as all innovation does. It has a very strong effect in the early years and then sort of tends to stabilize. When we look ahead, we have to look at what the next technology shock or productivity shock, where it's going to come from. I don't know the answer to that. You are the entrepreneurs. You are sort of in the process of discovering this. But I think there's one area which we need to be very concerned about, and where I think the opportunity, if not through private business, certainly through some combination of state and private action, need to come together, is food. A major hindrance to controlling inflation in this economy today is what has happened to food prices. And in particular, what is happening to the price of two categories of food. One is proteins, one is vegetables. We've seen complete stagnation of productivity in these items, as a result of which growing demand is translating very rapidly into higher prices. The supply response is minuscule, negligible. And as a result, this creates complications across the board in terms of the deficit, in terms of the inflation management strategy of the central bank. It has multiple, and in terms of its impact on nutritional standards as well, because people who should be eating a more balanced diet are actually being shut out to some extent from proteins and vegetables, which are critical sources of nutrition. So here is where I think perhaps the next technology shock needs to come. It's not the only one, but to me it's a very critical area. And to the extent that we can deal with this problem fairly quickly, I think it bodes very well for a sort of revival or return to the kind of positive macroeconomic environment that we experienced during the high growth phase. So let me conclude with that. I hope it's been a useful perspective, and once again, thank you for inviting me to speak.
Dr. Gokarn, thank you so much for your views. And in fact, I couldn't agree with you more on the food part. And I'm glad to tell you that many in this audience, private equity managers, some of them do a lot of work in the clean tech and agriculture enabling areas. So they invest in companies that improve the capacity of doing better agriculture, or they are working with technologies that enable better technology for agriculture. So thank you, sir. Our next speaker, Mr. Chauhan, is the Managing Director and CEO of Bombay Stock Exchange. Of course, everybody knows, or some of you know, that BSE started under a banyan tree right in the city a few hundred years ago. And if we know about equity in this country, it is thanks to BSE. Mr. Chauhan himself has had a very distinguished career. He is one of the founding members of the National Stock Exchange, which revolutionized stock exchange operations in this country, made it professional. And then he went on to work for Reliance Industries. Perhaps some of you all will know that he has also been with the Mumbai Indian team. So I guess he is very much part of the cricket circles, as we almost are, all of us are almost are. Mr. Chauhan holds a BTech in Mechanical Engineering from IIT Mumbai and MBA from IIM Calcutta. He serves on various boards of ICCL, CDSL, USC, etc. Sir, we welcome you here today for this August gathering, and we'll be much wiser by your thoughts and comments. Mr. Chauhan, thank you, sir.
Thank you, respected Dr. Subir Gokarn. It's a pleasure and honor to be here. Probably let me, since it's a what I call gathering of the private equity investors, and also I was told there are several entrepreneur sitting here. So let me give you a perspective. I have been an entrepreneur, and I have also been an investor. And so, when we set up NSE, it was, although we were setting it up for IDBI and other investors, which are all practically government-owned. But it was basically an entrepreneurial sort of situation. And what was actually invested was 25 crore rupees. That was in 1994. 93 is when I wrote the Articles of Association and first business plan, immediately after the Harshad Mehta scam. And today I think it's valued around $4 to $5 billion. So not a bad investment by, and many of the companies which invested in those days, which were superstars in those days, practically survived on only selling NSE shares every year and showing profits till now, right? So that is one of my earlier sort of experiences of sort of entrepreneurial ventures, and then it became successful. And in 2000, it was a euphoria. So, and in a sense, what we did in those days in 93, 94 was later known as e-commerce, because you transact on screens, right? So later on, I figured that what used to be called stock trading on screen is now coming in the new wave called B2B e-commerce and stuff like that. So I said, I have been setting this up for India, so why don't I start on my own? So like any young guy who has been reasonably successful in job with very little salary after tax, so I thought everyone is becoming sort of a billionaire, why shouldn't I try? And so I started on my own a new venture called Exchange Next. It was supposed to be an exchange platform for setting up many exchanges, which would be sort of like I started an exchange called Petrochem Next for transacting petrochemicals, polyester, and so on and so forth. Another exchange I started was something called Steel Next, which was basically, as the name suggests, steel exchange. Then we started Paper Next, and we had basically a framework to create as many exchanges on the runtime as we want. And I was really delighted, and B2B e-commerce was going, and I thought I'll be pretty successful. But by the time we started the first market, I was financed by Reliance Group those days. And so they had need for the Petrochem market, so we started Petrochem Next. And by the time the first market started, the actual e-commerce and the entire dot-com boom collapsed. And we had this Ketan Parekh scam. And so everything went for a toss, and I had spent a lot of money. And I didn't know where to go, because I was basically a bureaucrat sort of starting up a business. And I said, now where do I go and get a job? Fortunately, when I had some skills in IT, I had skills in various other areas. And so Reliance Group said, okay, why don't you run IT for us? And I ended up running for IT for them. But that was my another experience of entrepreneurial on my own, and which basically failed. And then later on, as a hobby, because I had set up derivatives for NSE, so many brokers later on, when derivatives was allowed, they came back and said, why don't you do something for us in back office, because the current vendors are charging us huge amounts. So when I started earning a lot, because of the private sector, salaries were much better than sort of NSE was public sector when I was working. After I left immediately, they raised salaries manifold, but I was not lucky. And so I started kind of as a hobby, I started investing my salary into creating a back office system. And it became pretty large, and many of the largest brokers in India started using it. Today also, in some sense, they tell me that they became large because of they could have that back office system. And then at some point in time, BSE wanted to sort of get an IT company, because they were figuring out that NSE had IT company, and there was a new competition coming which had an IT company, and which was rather an IT company itself. And so they were like feeling lost, and they approached me saying, would you sell your company? And I said, gladly. Because by the time the market had tanked, I had to put in even more money. I had sold the company, it came back because the new entrepreneur couldn't pay up the bills. And so it came back and I had to put in more money to even survive because no broker would end up paying the bills after 2007. So somewhere on the line, by the time it was 2009, it had already come back and it was highly profitable and so on and so forth. So finally, BSE decided to buy the company, and I was also delighted. I was running another entrepreneurial venture called Mumbai Indians. And so, and it was, even now people ask me, where did you leave that job? I mean, BSE is so boring. And so, and the idea there was to create business out of cricket, first time. And so, but finally I said, personal money is better than running very exciting stuff. I have done a lot of exciting stuff, but never made money, especially the retirement funds. So finally I sold it off to BSE, but they also put in a last caveat before signing, saying that you'll have to work for us for 1 year at least, so that there is a good integration. And so I came into BSE, and then later on, now I become CEO. So that is my, what I call entrepreneurial come bureaucratic journey in life. And good thing is that I have not been very successful in entrepreneurial stuff. So I had kept the money, I mean, this company was in my wife's, when my wife was holding it. So I think she became successful, she became rich. But one of the biggest issues that I've been facing, and I've been telling entrepreneurs now that I also market SME exchange. BSE started this small and medium sector enterprise exchange. So I keep on basically telling the entrepreneurs that best thing to do in your life, if you have a running business, one is convert your income into wealth. If there are any entrepreneurs, convert your income into wealth, and that can happen only on stock exchange. Or you sell out the company, whichever way. Right? Second thing is, if you convert your income into wealth, it's very important for you to do it on an exchange, because the government has given fiscal incentives that if you hold your shares for more than 1 year, then capital gains tax is exempt. So at the end, you don't end up paying taxes, because your hard-earned money, when it is coming, actually you realize that after paying all the debt, sort of creditors and everything, what you get is very little, and that also goes in for taxes. So whoever I meet as an entrepreneur, who is, I mean, I have not been a successful entrepreneur, but at least I can be a successful marketing guy. At least I have an aspiration to do that, right? So somewhere on the line, I keep on telling people that, boss, convert your income into wealth by listing. Second is, even for succession planning, for sort of using it as your own currency. Because when you list, you end up creating, although we have a deputy governor of RBI sitting, I keep on saying that, oh, मैं धारक को 100 रुपया देने का वचन देता हूँ, that is only RBI governor can sign. But if you list, you are your own governor, right? Because your company's prices move against Indian currency prices, right? That is your hard work. And that is so exhilarating, right? That if you are successful, even if you are not, you can use that currency to acquire some employees by giving them stock options. You can acquire other companies by giving stocks and so on and so forth. So you create your own currency, right, when you list. It is, I'm telling you, if you actually are an entrepreneur, you start crying when 30-40% goes away like this. Saying, boss, this is what I thought is going to come and nothing is coming now, right? So somewhere, now coming to this concept, I was told I need to give you a framework of why the exchanges exist and why not the entire world can be private equity only. It should be only private equity, and why exchanges exist. For me, and of course there is this exit route called listing on stock exchange. That's why the exchanges should be there at the end of the movie. But why they are, when even similarly at the end of the conference you have put the exchange. So basically the framework is somewhere on the line, exchanges play a very, very kind of interesting and important role in corporate democracy. It is in contrast to the private equity framework, but it is also in complement. In a sense, what public markets do is that they put an onus on the entrepreneur to behave in a particular way. Even with all the caveats you have in your agreements with the entrepreneurs, you may still not be able to control him. See, for me, all of you, especially who are not entrepreneurs, who are investors in a sense, either venture capitalists or private equity guys, you are like Abhimanyu. You go into Chakravyuh, but you don't know how to come out. Because coming out is in that guy's hand. And that's why, again, in SME specifically, I tell venture capitalists, angel investors, saying, boss, at the time of investing, you tell the guy that I will invest, you go to SME segment of BSE, list there, I invest at that time. So I actually create my exit at the entry only. Then the public, that is the government, the institutions like exchanges, SEBI, Ministry of Finance, everyone else, will also ensure that the guy has to declare his half-yearly results, if not quarterly, if he's on SME. They will also be after him to do many things which you want anyway him to do, right? So for me, the stock markets act as kind of huge incentives or a complement to a private equity framework. And still over last 30, 40 years, I mean before 30, 40 years, private equity was not so much in vogue. Stock markets were practically the only framework which were basically working out. And then came NASDAQ and the California sort of IT companies and HP and so on and so forth. And that's where basically what I call risk capital, rather very, very high risk capital started coming in to garage companies and so on and so forth. And then you had many of them becoming pretty large, Microsoft and Cisco and so on and so forth. And that's where you could actually generate huge returns out of very little investments. And that's what Dr. Gokarn said about the technological shift that took place in the world market, that last 30 years have seen huge changes that have not been seen last 10,000 years before. In terms of the concept of capital, earlier, if you put in X capital, you will get Y capital out or Y profits. It was a very linear situation. And the technologies will change over generations, 1 or 2 generations will take. Only in last 30 years, we started getting what we call non-linear or optionality into decision making or investments. And that's where the smartness of the decision making became much more important than how much capital you had. And that's where somewhere on the line, this private sort of market started coming up, where the public could not price it because information was not available or decision making parameters were not available. Private guys with specific skills knew where it is coming from and what it can do, whether a Facebook can do or a Google can do or a Microsoft can do. And that is where, for me, the private markets became that much more important. When they started making more money, even fools like us started saying, okay, boss, you manage my funds. And that is how this entire, what I call private markets came up. But finally, for valuation, you need to go to the public markets, and sometimes you have to actually come out of the public markets like Mr. Dell is doing nowadays. Right? He is taking Dell private now after listing for so many years, $25 billion, he is making it private now. And so you can continue to do this jugglery, but many of you will have to start sort of at some point in time ask for exit. Nowadays, my ex-colleague Akhil, he seems to be investing basically in public companies only, in private equity. So somewhere on the line, many of you seem to be investing in already public companies. Some of you invest in some part public, part private. But effectively, coming to a public market is very important for many of you. One of the biggest issues, the way I look at it running an exchange, is that what is my job? Like any democracy, this is a corporate democracy. And my job is to basically protect what I call minority rights. Who is minority? The guys who are not connected, who are not owners, who are not owner managers, who are not managers, who are not investors who have some sort of control over managing the company. If I can protect the rights of the minorities, which could be you tomorrow, then the corporate democracy will survive. If majority starts taking away all the profits and shares all the losses, then slowly nobody will invest in public markets. and then you don't have markets. So the protection of minority rights is basically the job of an exchange. The other job is what we call price signaling. Many people think the transaction processing is the only job an exchange does. But what is more important is what we call price signaling. Because if you see, I mean, many of you might be from Bombay, and you might have heard that in Lower Parel, this area, price like Ashok Tower, price of real estate is 40,000 rupees a square feet. It is not that all the flats are being sold at the same time every day, every moment. One flat in 3 months ends up deciding the price of not only Ashoka Towers, but even surrounding areas, including Chauhan and so on and so forth. That price signal, that 40,000 rupees a square feet, has to be squeaky clean. If it is not trusted, then you are not trusting the prices that are coming, and then you are not trusting the wealth that is coming. And for me, if Bombay Stock Exchange today represents around $1.3 to $1.4 trillion, and if you are not clear that that price could be 20% here or there, or 50% here or there, or if it is rigged, then the entire premises of having an exchange goes away, right? So for me, price signaling is an sort of extremely important part, and that actually comes out of transaction processing. That is all the trades that happens, whether on floor, on screen, and so on and so forth. So if you worry about that price signaling part, which is what generates or what sort of depicts the wealth of a country, of an economy, it is extremely important of an entrepreneur. And when that happens, you start asking a question, saying, is it a public utility or a private profitable entity? I am both. I am a regulator of the first layer. I am a public utility because it's a public good, which is what I provide. And I am still a private entity with profit motive. So that brings me to my marketing role, is that some of you are investors and have still got some money to invest. BSE is planning to come out with an IPO. So you might like to sort of think it's a 137-year-old marquee brand, 5,200 companies listed, oldest in Asia, amongst the top in the world in terms of number of trades and so on and so forth. It's all fully automated. It has 40% owned by brokers, 30% owned by foreigners. That includes Deutsche Börse, Singapore Exchange, George Soros, George Kaiser, and so on and so forth. It has 30% Indian non-broker holders. That includes LIC, SBI, and so on and so forth. So we will have our IPO coming out sometime this year, hopefully, if everything goes all right. There is another question which people ask me about the new competition coming, that you have, once the new competition comes, all the investors in the world will be very happy, and suddenly everyone will shift to that exchange, and so we will have no work to do. That exchange is open. I am still waiting for that day to come. In the meantime, BSE continues to work well, and it is continuing to make sort of profits, and also does interesting stuff. So another question which especially policymakers ask me is, boss, all this is fine, you do microsecond matching and so on and so forth, but where is capital formation? Your main job is to allow the companies in the country to do capital formation. And I used to think of the sort of answers. I didn't have too many answers. But in last 2 weeks, BSE has been instrumental in collecting close to 25,000 crore rupees. None of you may be aware. It may not be there in newspapers. Doesn't mean it didn't happen. NTPC, 12,500 crores. Oil India. IRFC, that is Indian Railway Finance Corporation debt issue. HUDCO, Adani OFS, and so on and so forth. There are at least 24 to 20,000 crore rupees were collected without even newspaper noticing. Otherwise, everything is breaking news. But basically, capital formation in the country is not even reported, not even being made aware to you. So I thought, let me also act as a sort of a newscaster and give you this information that India is kicking, India is well, India is doing capital formation, and I think you guys are doing a great job in helping us do that. Thank you very much for calling me here. Really appreciate it.
Thank you very much, Mr. Chauhan. I was wondering, why did BSc get PE funding? Now we know the answer. An entrepreneur such as Mr. Chauhan is running the business there. So, now time for the Apex'13 awards. A brief intro for the awards. Started in 2007, the Venture Intelligence Apex Awards are the first awards of its kind for the private equity venture capital funds in India. A key feature about the Apex Awards is that the awardees are chosen by a jury panel consisting exclusively of limited partners, that is investors in PVC funds. The jury members for Apex'13 Fund Awards included executives from Adams Street Partners, Asia Alternatives, BlackRock Private Equity Partners, Evolvence India Fund, Gokarn Capital, Morgan Creek Capital, Pantheon Ventures, Religare Global Asset Management, Sigler Gulf, Squadron Capital, and Setco. The first award for the evening for the category of Best Private Equity Investor 2012. The nominations in this segment included two previous winners of the Apex Awards, ICICI Venture and Bearing India, as well as new entrant Fairbridge Capital, which made a smooth execution of its $175 million buyout of an 87% listed travel service firm, Thomas Cook India, including a successful open offer. But the overwhelming favorite of the LPs in this category has been a firm that has produced one good exit after another over the last 3 years, displaying amazing discipline and consistency in terms of its timing of its investments and exits. In 2012, this firm sold its stake in Gujarat-based agrochemicals and custom synthetics firm PA Industries via the public markets, realizing more than 4x returns, and also deployed almost $225 million during the year, including in companies as varied as Pepsi bottler Varun Beverages International and post-product services firm Prime Focus to infrastructure-related firms like Karaikal Port, cryogenic storage transportation firm Inox India, and port management firm Ocean Sparkle, to manufacturing-related firms like Craftsman Automation. Please put your hands together for Standard Chartered Private Equity. We invite Rahul Raisunana, Managing Director, Standard Chartered PE, to come on stage to receive the award from Dr. Gokarn, please.
Thank you. I want to just accept this on behalf of the entire Standard Chartered Bank private equity team here, some of whom are present, including Namit Arora, Anshuman, I think Vibhav somewhere, a couple of others who are not, Nenesh, Mukul, etc. It really belongs to all of them. Hard work by all of them. I think it's been a great year. We tend to be a little understated because it's a principal investing shop. But it's good that some of these things do come out sometimes in the public domain, because in this gloom and doom scenario, at least there's some hope for all of us. Thank you.
The next award is in the category of Best Growth Capital Investor for the year 2012. As we all know, growth capital is a fairly competitive segment. The winner this year, however, has differentiated itself with its deep understanding of domestic businesses, including the hinterland. During 2012, it sold part stakes in 2 of its portfolio firms via secondary sale to other PE investors, realizing an average return of over 4x. The firm was the first institutional investor in these 2 companies when it entered them in 2008, Pune headquartered Parag Milk Products and Jaipur based AU Financiers. Now, it has worked with these relatively unknown companies, helped them scale rapidly to attract follow-on funding from very credible large PE firms, IDFC PE and Warburg Pincus, respectively. The year also saw the winning firm make a successful second close in both domestic and offshore vehicles on its second fund. Please put your hands together for Motilal Oswal Private Equity. We invite Vishal Tulsian, CEO, Motilal Oswal PE, to come on stage to receive the award from Mr. Chauhan, please.
Thank you, everyone. Somewhere awards have preceded carry. I hope carry also comes sometimes in the near future as well. That's what we are all working for. And 2006 was when we started this whole private equity business at Motilal Oswal. And with neither the sponsors nor the guy whom they hired could spell private equity properly. And in 7 years, getting an award for the best growth capital investor, I think, means something. Both the institution and the team, I think we worked very hard in the last five years, not just in terms of fundraising and investing, but also in terms of helping our portfolio companies grow. Somewhere, I think India has reached a stage where we strongly believe that private equity has become extremely important, particularly the growth capital, extremely important for the whole Indian ecosystem. Given that companies requiring $10 to $20 million would increasingly find it very difficult to go public, I think private equity is going to play a very important role for the growth of Indian economy, and I hope we all are able to do that over a long period of time. Thank you.
Attracted by the SEZ and other mega projects. Come the global financial crisis, and the foreign funds almost completely disappeared from the scene. Meanwhile, a few domestic fund houses, with their ears close to the ground, seem to have worked out what works and what doesn't in this emerging asset class under private equity. This year's winner has made 7 exits since December 2011, and its fund has reported an overall 1.65x multiple and blended IRR of 27%. It also closed a real estate yield fund at $113 million from domestic family offices. Please put your hands together for Kotak Realty Fund. We invite Srinivasan, its CEO, to come on stage to receive the award from Mr. Chauhan, please.
Thank you very much for recognizing our efforts. This was a business that we started in 2005, and I do believe that this is a sector which deserves significant more capital than what currently gets. We manage about $800 million at this point in time. We've given back nearly about $360 million in terms of exits over the last 6 years. And I think this will become a more integrated part of the private equity industry going forward. And I do hope to see more players and more recognition to this industry. And thank you for giving us the opportunity here.
The last but not the least award for the evening is in the category of Best Venture Capital Investor for the year 2012. At that time, the team behind this year's winner in the VC category came together. Venture capital in India was definitely not a very favorite asset class among institutional investors. But they seem to have timed the re-emergence of excitement in the early stage investments in the country almost perfectly. During 2012, In the process, they've also proved that it's possible to make the Indo-US cross-border theme work. During 2012, this firm sold its stake with committed capital of about $270 million. The year also saw 5 of its portfolio companies, US headquartered Pubmatic, Aryaka Networks and Kaltura, and the Indian headquartered Bhikshu Basar and Sohanlal Commodity Management, raise significant follow-on investments led by new investors. The firm also continued to remain among the most active VC investors in India, investing in 6 new companies during 2012. Please put your hands together to Nexus Venture Partners, the second time the firm is receiving an award. We invite Sandeep Singhal and Suvi Sujan, Managing Directors of Nexus, to come on stage, please, to receive the award from Dr. Gokarn.
First, I want to thank Venture Intelligence for hosting us, for the jury for selecting us for this award, and most importantly, I want to thank the entrepreneurs who have made this possible. I think when we started in 2006, there was a lot of questioning around whether there were entrepreneurs that were in early stage that would fund and build large companies. We fundamentally believed that India was on a cusp of a very significant change, moving from labor arbitrage to innovation, and we thankfully managed to convince some of our LPs, and that is another that group has really stayed with us, and has helped us fund some very great entrepreneurs who have built great businesses and have got us to this point. And hopefully, I think what Dr. Gokarn said around this whole technological shift, what we are seeing, and we are actually seeing it on the ground. There is the next stage. You mentioned the whole issue around the HPs of the world and so on, and how they have changed the way of exponential wealth creation. And I think I look at India today, and I particularly look at places like Bangalore, Pune, Chennai, and I see that we will see a HP or a Skype or a Cisco or a Google coming out of these places in this coming decade. And that's what excites us. Awards are nice to have, but it's really working with great people who are building phenomenal businesses that really keeps our juices going and keeps us having fun. Thank you very much.
We request all the winners of the evening to please come on stage for a photo opportunity, please. Also, we invite our co-host for the evening, Ashish and Investment Cafe. Please come on stage.
Great. Thank you very much. So please do join us for cocktails and networking. Thank you for being a patient audience, and for the net. Please join us.